$17 trillion disappeared from American households during the Great Depression. In just 4 years, stocks collapsed by 89%. 10,000 banks failed. Unemployment surged to 25%. An entire generation didn't just lose money. It lost faith in the system itself. Careers ended, savings vanished, futures were erased. History remembers it as the worst financial collapse America had ever experienced. Now here is the uncomfortable truth. The conditions we are facing in 2026 are not similar to that period. They are worse. Not emotionally worse, not politically worse, mathematically worse. And I don't need fear or speculation to prove it. I only need numbers, 4 of them. Numbers so extreme that most financial media avoids them entirely because once you see them together, the illusion collapses. Total debt inside the American system today stands at $98 trillion. That includes government debt, corporate borrowing, household credit, and financial sector leverage. Every promise made today against income that has not yet been earned. $98 trillion. In 1929, total debt adjusted to today's dollars was roughly $290 billion. That means the system today is carrying more than 300 times the debt it carried at the start of the Great Depression. But the real danger isn't just the size of the debt. It's how it's connected. In 1929, failures were contained. A bank failed in one state and damage stayed local. Today, everything is linked through derivatives, global funding markets, and digital liquidity. There are no firewalls. When something breaks, it spreads instantly. And unlike 1929, this crisis isn't forming in one asset class. It's forming everywhere at the same time. Stocks, bonds, real estate, even the currency itself, all inflated together, all vulnerable together. This isn't opinion, it's a historical pattern, a 4-stage cycle that is repeated across centuries with mechanical precision. And once you understand that pattern, one thing becomes clear. We are not approaching the crisis. We are already inside it. If this perspective resonates, comment 1. If you want me to continue to chapter 2 or 2. If you want me to stop here, subscribe and comment 1 if you're ready to see what comes next. To understand why 2026 cannot escape what's coming, you need to understand the mechanism, not opinions, not politics. Mechanisms, because debt crises do not happen randomly. They follow a fixed sequence, 4 stages, always in the same order, always with the same outcome, no exceptions in recorded history. Stage 1 is the foundation. Every major economy begins with real growth, productive labor, tangible output, innovation that increases efficiency. Money is sound. Debt exists, but it serves production. Credit finances factories, farms, infrastructure businesses that generate real cash flow. Debt is limited by the ability to repay it through actual economic activity. This phase creates legitimate wealth. It is slow, sometimes boring, but sustainable. Income grows. Living standards rise. Debt is a tool, not a weapon. This is the earning phase. Every empire, every currency system, every financial superpower starts here. Then comes stage 2, expansion. Credit becomes easier. Lending standards loosen. Debt begins growing faster than the economy itself. At first it feels harmless. Asset prices rise. Stocks go up. Real estate goes up. People feel richer even though productivity is no longer keeping pace. Borrowing against assets replaces earning through output. Banks lend more because collateral values are rising. Investors chase returns because prices keep climbing. Governments enjoy higher tax revenue from capital gains. Workers flood into finance, real estate, and speculation. The system begins rewarding leverage over production. Here's the critical shift. The economy stops depending on growth and starts depending on credit expansion. Rising asset prices justify more debt. More debt pushes prices higher. It becomes a self-reinforcing loop, and once the system reaches this point, stopping the expansion becomes impossible. Why? Because everyone depends on it. Banks depend on loan volume. Investors depend on asset appreciation. Governments depend on inflated tax receipts. Pension systems depend on market returns. If credit stops expanding, the illusion collapses. This is where every cycle becomes dangerous. Because stage 2 always feels like prosperity. People believe the system is healthy precisely when it becomes fragile. And history shows the same mistake every time. They assume it can go on forever. It never does. Stage 3 is where illusion meets reality. This is the moment the cycle breaks, not because something massive collapses, but because something small disrupts the flow of credit. A rate change, a policy shift, a loss of confidence, a shock that would have been harmless in a healthy system suddenly becomes fatal in a leveraged one. The key is this: Stage 3 does not begin with panic, it begins quietly. The weakest borrowers struggle first. They can't roll over old debt. They can't refinance at higher rates. They miss payments. Defaults appear isolated, a few companies, a few banks, a niche sector. Most people ignore it because asset prices are still elevated and headlines remain calm. But underneath, the math has already turned. Once debt stops expanding, the entire structure reverses. Asset prices stop rising, then they fall. And falling prices expose the lie embedded in the system. Collateral was never worth what it was assumed to be. When values drop, lenders demand repayment or refuse to extend new credit. Borrowers are forced to sell assets to raise cash. Those forced sales push prices down further. This is where the feedback loop flips. The same self-reinforcing mechanism that inflated everything now accelerates the collapse. Falling prices reduce collateral. Reduced collateral tightens credit. Tight credit forces more selling. More selling drives prices lower. Fear replaces greed. Liquidity evaporates. And here's the critical insight most people miss. The debt does not disappear. Every dollar of debt is someone else's asset. When borrowers default, lenders take losses. When lenders take losses, they cut lending. When lending contracts, economic activity shrinks. Less activity means less income. Less income means more defaults. Once this loop begins, it does not stop on its own. Cash hoarding replaces investment. Banks protect balance sheets. Markets become disorderly. Volatility spikes. And what looked like stability only months earlier suddenly reveals itself as extreme fragility. Stage 3 is not the collapse itself. It is the point of no return. Because once credit contraction begins in a system built entirely on leverage, the final stage becomes unavoidable. Stage 4 is where the system resets violently. This is the phase history remembers because this is where wealth is destroyed, not debated. Debts are erased through default, inflation, or both. Asset prices collapse until they reflect real economic output rather than leveraged expectations. And the social consequences spread far beyond markets. This is where the structure of wealth changes. Those holding inflated paper assets, overvalued stocks, long duration, bonds, highly leveraged real estate see their balance sheets disintegrate. The middle class, concentrated in financial assets and debt-backed property, absorbs the largest losses. Meanwhile, capital consolidates. Those with liquidity, hard assets, or real productive capacity survive and expand. Unemployment rises sharply as credit-dependent businesses fail. Investment freezes. Consumption contracts. Governments step in, but their tools are blunt and often counterproductive. Bailouts protect institutions, not purchasing power. Stimulus replaces defaults with inflation. Either way, real wealth declines. This stage always feels chaotic, but it is not random. It is the mechanical unwinding of excess leverage. The system shrinks until the debt load becomes survivable again. Only then does stability return, usually after years of pain. And then because human behavior never changes, the cycle begins again. History shows this pattern repeating with relentless consistency. Empires rise on productivity. They expand through credit. They fracture when debt outpaces income. They reset through collapse. Every generation believes it is smarter than the last. Every generation is proven wrong by mathematics. Now that you understand the full cycle, the next step is uncomfortable but necessary. We are going to map this exact 4-stage pattern onto real, historical examples, not theories, not hypotheticals, but documented collapses. You will see how precisely the sequence unfolds and how little imagination is required to recognize where we are today. Because once you see it, you can't unsee it. Let's lock this pattern in with history, not selectively, not emotionally, mechanically. Start with the Great Depression. Stage 1 was the foundation of the 1920s. Coming out of World War I, the United States experienced real industrial growth. Manufacturing expanded, productivity improved. The economy was genuinely producing more. The foundation existed. Then stage 2 arrived. Credit exploded, margin debt surged as investors were allowed to buy stocks with as little as 10% down. 90% was borrowed. Stock prices tripled in just a few years. Price-to-earnings ratios detached from reality. Speculation replaced investment. Real estate boomed. Get-rich-quick schemes flourished. Everyone felt wealthy, but the wealth was built on leverage, not income. Underneath, debt piled up everywhere. Corporate debt, household debt, farm debt, margin debt. The system became dependent on rising asset prices to function. Stage 3 began quietly in October 1929. Stock prices stopped rising. Margin calls followed. Brokers demanded cash. Investors didn't have cash. They had leveraged stocks, so they sold. Selling pushed prices lower. Lower prices triggered more margin calls. The feedback loop activated. Panic followed. Stage 4 lasted 4 years. Stocks fell 89%. 9,000 banks failed. 1/3 of the banking system disappeared. Depositors lost everything. GDP collapsed. Unemployment surged. Wealth concentrated violently as assets were sold at pennies on the dollar. The middle class was devastated. Now look at Germany 1921 to 1923. Stage 1. An industrial powerhouse with real productive capacity and a sound currency. Stage 2, debt obligations from war reparations forced money printing. At first, it felt manageable. Wages rose, spending continued. Stage 3, confidence broke, the currency collapsed. Stage 4, total annihilation, savings vanished overnight. The middle class was wiped out. Those holding real assets survived. Japan followed the same script decades later. Real growth, credit expansion, asset mania. A small rate hike triggered collapse. Stocks fell 80%. Real estate collapsed. Decades of stagnation followed. Different countries, different triggers, identical outcome. 4 stages, no exceptions. Now let's map that same pattern onto the United States, not emotionally, but precisely. Stage 1 is complete. America's foundation was real. After World War II, the United States emerged as the dominant industrial and financial power on Earth. Manufacturing boomed. Productivity surged. The dollar was anchored to gold. Trade surpluses funded real wealth creation. From the 1950s through the 1960s, income growth matched output. Debt existed, but it was restrained. Then came the turning point. In 1971, the gold window closed. With that single decision, all natural limits on debt creation disappeared. Money no longer represented scarcity. It represented policy. And from that moment forward, stage 2 began. Total credit market debt in 1971 was roughly $2 trillion. Today, it stands near $98 trillion. Government debt exploded. Household borrowing surged. Corporations levered balance sheets. The financial sector expanded faster than the real economy. Every slowdown was fixed the same way: lower rates, more liquidity, more debt. Each crisis deepened the dependency. The dot-com bust led to 1% rates. The housing crash led to 0 rates and quantitative easing. The pandemic triggered trillions in stimulus and negative real yields. Every intervention inflated asset prices further while weakening the foundation underneath. Stocks reached record valuations. Real estate detached from income. Bond prices surged despite exploding deficits. Everything inflated together. And here is the trap. The entire system now depends on asset inflation to survive. Pension funds require market returns. Governments rely on capital gains taxes. Banks depend on collateral values. If asset prices fall, the system cannot function. That is the definition of stage 2 exhaustion. The expansion phase is complete. There is no room left to grow without breaking the math. And that brings us to where we are now. Stage 3. Stage 3 is no longer theoretical. It is happening in real time. This phase begins when rising interest rates collide with extreme leverage. Debt that once looked manageable under 0 rates suddenly becomes impossible to service. Refinancing breaks, cash flow math collapses, and pressure appears simultaneously across the system. Start with rates. In less than 2 years, policy rates surged from near zero to levels not seen in decades. That single shift rewrote the cost of debt everywhere. Governments now face soaring interest expenses. Corporations must refinance at multiples of their original rates. Commercial real estate projects no longer pencil out. The free money era ended abruptly. Now look at liquidity. The financial system has been quietly burning through its buffers. Cash that once sat safely in reserve facilities is being drained. As those buffers disappear, institutions are forced to either accept lower returns or move into riskier assets. When liquidity vanishes, markets don't adjust smoothly. They gap. Next, look globally. Rising rates in Japan are forcing the unwind of massive currency trades that once flooded United States markets with cheap capital. Trillions borrowed at near-zero rates must now be repaid. That repayment requires selling United States assets. At the same time, foreign demand for United States debt is declining. Supply is rising. Buyers are shrinking. Prices must adjust. Then there is commercial real estate. Trillions in loans are coming due against properties worth far less than when they were financed. Vacancy rates remain elevated. Refinancing fails. Defaults begin. Banks absorb losses. Lending tightens. Stress spreads. None of these are isolated events. They are converging. Rising rates, tightening liquidity, forced selling, falling collateral values. The feedback loops described earlier are now active. Asset prices soften. Credit tightens. Fear replaces confidence. This is stage 3. And history shows what follows. Stage 4 begins when pressure turns into acceleration. This is the moment when containment fails and the system moves from stress into disorder. What makes this cycle uniquely dangerous is that every major asset class entered stage 3 inflated at the same time. In past crises, something usually held. Stocks collapsed while bonds survived. Housing fell while equities recovered. The currency anchored the system. This time, nothing is isolated. Stocks are priced for perfection after years of zero-rate distortion. Bonds face losses from rising yields and expanding deficits. Real estate is burdened by leverage at peak valuations. And the currency itself is no longer anchored to anything but confidence. When one breaks, they all transmit stress to each other. Forced selling becomes the dominant force. Margin calls trigger liquidation. Falling prices reduce collateral. Banks demand cash. Borrowers sell whatever they can. Liquidity disappears precisely when it is needed most. At the same time, policymakers face an impossible choice. They can intervene by cutting rates and printing money, which stabilizes markets temporarily but destroys purchasing power. Or they can allow defaults to proceed, which preserves the currency but collapses asset prices. Either path destroys wealth. This is why modern debt crises produce the worst outcome of all stagnation combined with inflation. Growth disappears while prices rise. Real incomes fall. Savings lose value. Trust erodes. History shows that once stage 4 begins, it doesn't end quickly. Attempts to delay it only increase the eventual damage. The system must shrink until debt once again matches productive capacity. And that brings us to the final question. What does this mean for you? For most people, the real danger is not the collapse itself. It is being positioned wrong when it accelerates. Debt crises do not destroy everyone equally. They destroy specific behaviors, overexposure leverage, and blind faith in paper assets. Ironically, the people who suffer most are often the disciplined savers who followed the rules of a system that quietly changed. The middle class is always hit hardest. That is because their wealth sits exactly where debt cycles do the most damage. Retirement accounts tied to stock markets. Homes bought near peak prices with leverage. Bond portfolios built on the assumption of stability. Pensions that require constant growth. All of it depends on asset prices staying high and currencies holding value. When stage 4 unfolds, those assumptions break at the same time. This is why understanding the mechanism matters more than watching headlines. Recessions recover, corrections rebound, debt resets permanently alter the system. History is consistent. Every major debt collapse transfers wealth from those holding financial claims to those holding real control, paper to tangible, promises to possession. The transfer is not announced. It happens through inflation, defaults, and forced selling. Most people will not adjust in time. They will wait for confirmation from institutions that cannot give it. By the time the narrative changes, options are gone. This is not about panic, it is about clarity. You cannot stop stage 4, but you can recognize it. History is unforgiving, but it is also generous to those who pay attention. Every debt collapse teaches the same lesson. Survival is not about prediction, it is about positioning. The people who endure are not the smartest, the fastest, or the loudest. They are the ones who understood the structure of the game before the rules changed. Stage 4 punishes leverage. It punishes concentration. It punishes blind trust in systems built on perpetual expansion. What survives are assets and behaviors grounded in reality, liquidity when liquidity disappears, purchasing power when currencies weaken, and cash flow that does not depend on rising asset prices. This is not a call to panic or gamble. It is a call to think strategically. Reduce fragility. Eliminate exposure that depends on perfect